What if you could generate income in the stock market without needing prices to skyrocket? That's where options come in. Today, we'll break down how selling put and call options works, and how strategies like covered calls and cash secured puts can help you earn steady income. A call option gives the buyer the right, but not the obligation, to buy a stock at a specific price, called the strike price, before a set expiration date. A put option does the opposite. It gives the buyer the right to sell a stock at the strike price. Option prices are based on three main inputs: strike price, the price at which the stock can be bought or sold, time to expiration. More time means more value, implied volatility, the market's guess at how much the stock could move. With a covered call, you sell a call option against stock you already own. You get paid up front, the premium, but if the stock rises above the strike price, you'll likely have to sell your shares at that price. If buying 100 shares is too damn expensive, try a poor man's covered call. Instead of the stock, you buy a long-dated call option and sell a shorter-dated call against it. This lowers the upfront cost while still generating income. With a cash-secured put, you sell a put option and set aside enough cash to buy the stock if assigned. If the stock stays above the strike, you keep the premium. If it drops, you buy it at a discount. These strategies are powerful, but not without trade-offs. With covered calls, you give up potential upside. With cash-secured puts, your money sits idle until exercised or not. Here are 4 clear payoff diagrams illustrating the key options positions. This video is focused on selling options for income generation, but we are showing the long and short option payoff diagrams. Short call, lower left. For naked short call, the premium received is maximum gain, unlimited risk if the underlying spikes above the strike. Most investors can only get approval to do covered calls where the seller of the call also owns the underlying shares. In that case, the call seller will receive the call premium and upside only up to the strike price on the underlying shares. Short put, lower right. Income limited by the premium, but risk exists if the underlying crashes below strike. Most brokerage companies will require that the put seller set aside cash in case the put is exercised, and the put seller is required to purchase the underlying shares. In volatile or sideways markets, selling options can provide consistent cash flow while reducing your average cost or even entering positions at a discount. But always manage your risk, because if the market moves too far, you're on the hook. Used wisely, these option strategies can turn your portfolio into an income machine. Just remember, nothing's free in markets. Know the risks and trade. Smart Market Atlas is not a financial advisor, and nothing in this video should be taken as personalized investment advice. Before using any financial strategy, including selling options, investors should do thorough research.